So, so we finished the exercise 1 regarding the residential tie. The next one will be temporary absence. Temporary absence is that where an individual leaves Canada for a temporary period of time. Is if during his living period, does he need to pay the income taxes? Does he need to pay a Canadian income taxes? Right. So that is a temporary absence. When we take a look at this kind of situation, and you need to decide it if this person during the temporary absence, if he needs to pay the income taxes, we need to take a look at 3 status. So first one, the factors we need to consider is, the first one is intent. So that means that whether this individual intended to permanently sever residential ties with Canada. So we have examples. An individual has a contract for employment and he or she returns to Canada. This will be reviewed as evidence that he didn't intend to permanently depart. Another factor would be whether the individual complied with the rules related to permanent departure. Okay. We're going to talk about detail in chapter 8 regarding this temporary departure from Canada. So you just need to understand about the intent is that if he means to be permanently live Canada and sever all the residential ties, like to sell his house and to close all the health card, driver's license, registration, and also he take all his wife, acute children's, everybody left Canada. So if it's intended to do that. And the second one is frequency of visits. So if the individual continues to visit Canada on a regular basis, especially, we're going to talk about examples regarding that, the frequency of visit. The third is the residential ties outside of Canada. So is whether or not the individual established residential ties in another country. So if someone leaves Canada and travels for a extensive period of time without settling any one location, we could take a look at this person as still as a resident of Canada, because he is not permanently departed from Canada, because this person cannot find a specific country or places to live in on. So there's 3 factors we need to consider regarding the temporary absence. Same thing, we can do exercises. So the exercises, I think it's exercise 7, right? So let's talk about temporary absence. Jem is a Canadian citizen. She's employed by a multinational corporation while she has worked for many years in Canadian office of his organization. She agreed to transfer to the corporation's office in Florida. So goes to United States. Before leaving, she disposed of her residence and other personal property that she did not wish to move. And she canceled her Alberta driver's license and health card and closed all of her Canadian banking and everything, every account, right? But because her husband remained in Edmonton, so she flew back to Canada at least once a month. And after 26 months, she decided that between the excessive heat and humidity in Florida and the travel required to maintain the relationship with her husband, boyfriend, she would return to Canada. So at this point, her boyfriend is not her common law partner. Would Jen be considered a Canadian resident during the 26 months that she was absent from Canada? We could argue is yes, she is a temporary absent, but does she need to pay income taxes from Canada? Consider, we see no, maybe no, right? Because at the first paragraph, we can see that she actually savored most of her residential tie. And it's intensively that she wants to sever the residential ties with Canada. The only thing that the Canada government or CRA maybe argued is because she flew back once a month. That's a regular basis. So we can argue, they can argue that she still keep connect with a Canadian. So she could be Canada resident. She needs to pay income taxes during the 26 month. But maybe it will assess by the CRA, but they need to prove that they strongly believe she will need to pay the income taxes. So from all those two kind of exercises, we can have a feeling that all those cases is not a like 100% right question, right? For example, for this one, you could argue under your side, you could argue that she needs to pay because she flew back regularly with and keep the connection with her boyfriend, even though it's not spouse, it's not a partnership, it's a common law partnership, right? But you still can argue about that. In the meantime, you could argue that no, she's not a Canada resident because she intensively and she intend sever all those Canadian residential tie with Canada. She canceled this because she sold that, and she tried to just cut off everything that related. So it's kind of it's not like a black white. You could always argue your answers. So when you do your tax, so when you're working on your tax, there are also maybe 80% you can argue as a one side and 20% you can argue from either side. Is the judgment or the discussion will go with the CRA. So they could argue you, they could question you about your decision, right? But they all the same thing, like CRA has to provide sufficient information to support their argument. So like, yeah, for everything, you could always argue which way you wanted to go. For exercise number 7, like we just mentioned before, you can argue as temporary absence, or you can argue like it's not temporary absence, she has to pay income taxes on that. Now, so we are going to the next part. The part year residence. So part year residence taxation basis. Part year is in a year in which a person terminates residence in Canada. They will be taxed in Canada on their worldwide income for the part of the year in which they're resident in Canada. So we coming to Canada depends on the portion of the year, like which date or the month they come into Canada. So this is entering Canada, right? They usually coming with the immigration rules. Is Canada, we're not discuss the detail in this chapter. There are also other informations or factors we'll need to consider about the part year residence, like which part, like for how many months we need to consider she needs to pay a Canada residence, as a Canada residence, and need to pay Canadian income taxes. The most important is the one we talk about more in this chapter 1. We talk about living Canada. So departing Canada. Departing Canada, we consider the latest date of the 3. So the latest date of departure date, or departure of spouse and dependent, or establishment of new resident. So you need to compare those 3 days, and then you figure out which one is the latest one. You're gonna take that latest one as the time she left Canada, and then before that date, they need to pay income taxes in Canada, income taxes. We're gonna have examples again. Question number 8, part year residence. We'll figure out a better one. Okay, first one maybe. So Mark is a Canadian citizen, and since graduating from university, has been employed in Vancouver. He has accepted a new position in the United States, and on February 1st of the current year, flies to Los Angeles to assume his responsibilities. He has been granted a green card to enable him to work in the US. So that's the same date as February 1st. His wife remains behind with their children until June the 15th, the end of the school year. So on that date is June 15th. they fly to Los Angeles to join Mark. Their residence is sold on August 1st of the current year, and which time a moving company pick up their furniture and other personal possessions on August the 1st. The moving company delivered all those possessions to their new house in Los Angeles on August 15th. So how Mark will be taxed in Canada during the current year. So we take a look at those dates. First one, February 1st. So February 1st is the date the person Mark left Canada, right? February 1st is also the date he becomes a resident of the country to which he is immigrating. So he got a green card. So that is February 1st as well. And the next one we take a look at is June 15th, is his wife and the children fly to Los Angeles to join Mark. So that's June 15th. And August 1st is the date they are moving. They sold their residence. And August 15th is the date they received all the delivery. So when we took a look at this one, and then we just go back to the one we talked about it. So you compare those dates, and you need to figure out which date is the latest. So February 1st is the date I live in Canada, and February 1st is the date he becomes a resident of the United States. And June 15th is the days for his spouse and children to join him. When we compare the three, so we see that, okay, so June 15th will be the date, is the latest date. Then be taxed, so Mark will be taxed on his January 1st to June 15th. June 15th is the latest date. So the income taxes for the partially he needs to pay is from January 1st to June 15th. During this time, the income he has been made. So that is the part-time residence. We need to remember all those rules to compare the latest date when departure Canada. Similar for the exercise 1.9, so you can just go ahead and do the exercises. The good way for those exercises is you always can go back to the solutions. So you can just go click, you will see all those solutions. I'm not going to do it because I have to come back and find out the correct pages. Yeah, you can click on it so you can see the answers for all those exercises. It will help you to better understand the situation. Now, next one, we're going to talk about deemed residence. What is a deemed residence? So we just talked about Canadian residence. So on the basis of the residential ties that we have discussed, right? But deemed residence, they are also, for the Income Tax Act, extended the meaning of resident to include a certain other individual who are considered deemed residents. As we will see that individual can be a deemed resident even if they do not set foot in Canada in the relative taxation year. So if this person is not actually come to Canada or step into Canada, it still can be a deemed resident. So how are we going to figure out if this person are deemed residents or not? The first rule, wait, there's one more thing I need to mention is regarding the deemed residents and the part-year residents. Deemed residents are taxed on their worldwide income for the entire taxation year. So part year is you just need to tax by a partially, right, for during that year. But for deemed residents, you are taxed on all of your incomes for the entire taxation years. Okay, so the first one is deemed residence situation is the students in Canada for over 183 days. The definition for the students, we have talked about a little bit more in our textbook. Student is individual who is temporarily present in Canada for a period of 183 days or more during any one calendar year. This person is deemed to be a Canadian resident for the entire year. If this person is come to Canada and more than 183 days. But if this person has been given up all his residence in another country and moves to Canada, that were not considered as a deemed residence, that will consider as a part-time, part-year resident, is not a student. So yeah, the same, like when you think about it, it's like if you got a permanent residence card and then you give up your other country's resident, right? You come to Canada. That is not a sojourner. That is a part-time tax resident. And if a Canadian Canadian residents who leaves Canada to take up a residence in another country on September 1st would not be a sojourner. That even if he or she is in Canada for more than 183 days, well, 103 days in a year. So this is a big difference between a sojourner for income taxes on his worldwide income for the entire year, or the portion of the year when he or she was in Canada. And or there are also some situation that if the person got employment purpose and come to Canada for over 183 years, this person cannot consider to be a sojourner. Okay. So sojourner is always a person is temporarily present in Canada for like travel purpose or like visiting purpose. It's not like employment purpose. Employment purpose you cannot see as a student. And then the second, we can talk about second is members. At any time during the year of the Canadian Armed Forces when stationed outside of Canada, this person is a deemed resident. Number three, ambassadors, ministers, and high commissioners, officers or servants of Canada, as well as agent general officers or servants of province, provided they were Canadian residents immediately prior to their appointment, are considered to be deemed residents, like diplomat. Right? So there is example saying that the spouse of no, I'm gonna finish this. So there's a Canadian diplomat working in the U.S. He will be deemed residents of Canada, right? Because it's ambassador. He worked for the government as high commissioners, right? So it's deemed residents. And then number four is an individual performing services at any time in the year in a country other than Canada under a prescribed international development assistance program of the government of Canada. So this person is under a special programs from government of Canada, and provided they were resident in Canada at any time in the 3-month period preceding the days on which those services commenced. So you're going to states under this international development program from Canada government, and then we see that you're going on March, and then back to the 3-month period preceding the date you are resident in Canada, and then you are deemed residents. Okay. So number five, a child of a deemed residence, provided they're also a dependent whose net income for the year was less than the basic personal credit. So that's a deemed residence, is a children who is a deemed residence children, and probably the child has never been to Canada, and the child hasn't been working and is very low income, then the child is a deemed residence as well. Number six, an individual who was at any time in the year under agreement with one or more other countries entitled to exemption from income tax otherwise payable in any of those countries, because at that time the person was related to or a member or of the family of an individual who was resident in Canada. We have those examples. So saying that a spouse of a Canadian diplomat working in the States will be exempt from U.S. income tax under the governing international tax treaty because he is the spouse of the diplomat. So this spouse will be a deemed resident of Canada under this number 6. There is an international tax treaty, right? So the person of the spouse of a Canadian diplomat doesn't need to pay taxes, income taxes, but if she is a deemed resident of Canada because she's a spouse of a Canadian diplomat. Under number 3, ambassador, minister, or high commissioners, they're deemed residents of Canada. So that's the deemed residents. It's a little bit confusion, but we'll go from one example as well. So go question number 10. Question number 10. So Miss Sue Blakey, Miss Suzanne Blakey was born 24 years ago in Paris, France. She's daughter of a Canadian High Commissioner serving in that country. Her father still holds that position. So, however, Miss Blakey is now working in London. The only income that she earns in the year is from her London marketing job and subject to tax in England. So she made more money that she needs to pay taxes in England. She has never visited Canada, determined the residence status. So we can see Miss Blakey. First, she's not dependent. She's 24 years old. She's not dependent, even though her father is still the Canadian High Commissioner in France. And then the income. The second one is the income. She made more than the personal income exemption credit, right? It's $12,000 in 2019. So based on those two situations that we can see, Miss Blakey is not a deemed resident. Okay. Yeah, always go back to the 6 rules and then compare to the situation. You can figure out. The next one is dual residency. So the dual residency is tax treaties have tiebreaker rules. Sometimes when the person, like a Canadian Army, they probably stationed in another country, but he's Canadian citizen. So they are treated as a dual residence, and then under dual residence, that they probably need to double taxation for both countries. So this tiebreaker rules is help to release this kind of situation that and making the person not double paying income taxes. That is how the tiebreaker rules work. Now, when we talk about a Canada-US tax treaty resolve the dual residence problem, they have figured out a few, like 4 different factors to be considered. If the person working in United States and Canada, so there is a tiebreaker rules applied to it. These factors applying in the following order, which means you always take a look at permanent home first. If the individual has a permanent home available in only one country, the individual will be considered a resident of that country. So always take a look at permanent home. You're following this order. If the permanent home cannot be a considered factor, then you move on to the center of vital interests, which means that if this person has permanent home in both countries or neither, there's no permanent homes in both countries, then this will look to the country in which the individual's personal and economic relations are greatest. So such relations are virtually identical to the ties. So we need to, after we take a look at homes, then we take a look at the center of the vital interest, see if the personal or economic relations are stronger in which country. Then we decide this person is the resident of that country. And then if that cannot be determined where this person should be the resident, then we need to take a look at a habitual abode. Is that the country where the individual spends more time will be considered country of residence. So this is the third factor. If this rule still failed to resolve the issue, then we'll take a look at citizenship. So if this person will be considered a resident of the country where the individual is a citizen. Okay, if all of those 4 tests cannot resolve the problem of which country is the residence, then we need to go to the competent authorities. The competent authority procedures is, we didn't talk about the detail, but it's opening a dialogue between the 2 countries for the purpose of resolving the conflict. So this goes to the government level. It's not, you cannot figure it out by yourself, and then you have to dealing with the 2 different government, right, or CRA or agencies to deal with specific questions. So that's basically the residence questions. Yeah, we also talk about residence corporation, So if your company is incorporated in Canada after April 26, 1965, we say it's a deemed resident. And if you're before April 27, 1965, the corporation still deemed residents if it was resident at any time or carry on business in Canada. In trusts, management, beneficiaries, assets, we didn't mention about corporation and trust a lot because we're focused on the personal income taxes in this book. So basically, we just talk about personal income taxes. Now we talk about non-residents. Non-residents, we could see that if a person who is non-resident, does he need to pay income taxes, right? There's 3 types of incomes for non-residents. One is employment in Canada. The second is carry-on business in Canada. The 3 is disposition of taxation Canadian properties. So at any time in the year or a previous year, income tax will be paid as required by the Income Tax Act. On a person's taxable income earned in Canada for the year determined need to pay or not. So taxable income and most deductions are available. Tax payable, most credits are not available. Now, employment income. Employment income means the income earned by non-residents while working in Canada. We had examples, right? That examples will be a U.S. citizen who is a resident of Michigan, but he is employed at automobile plant in Windsor, Ontario. Such an individual will be in general be subject to Canadian tax on his employment income. But if he had another source of income, say a rental income property from states, it's not taxed in Canada. So in Canada, we only tax their employment income that earned in Canada, not the other source of income. So this is the employment income. Business income. So business income means the Canadian taxes on persons who carry on business in Canada. We're going to talk about this more in chapter 20 for carrying on business in Canada. But it also has a example. So if a U.S. corporation has stuff selling products in Canada, it should be taxed as a non-resident carrying on business in Canada. However, the Canada-U.S. tax treaty exempts a U.S. enterprise from Canadian taxation unless it's carrying on business through permanent establishment in Canada. So if you have your companies, your specific buildings, your like physical building or plant in Canada, then you need to pay in Canadian taxes on the products you're selling because that's your carrying on business in Canada. But if you only have a self-staff, it's like a sales. The sales selling the products in Canada that doesn't need to pay income taxes on that part. And then this will be talked in the following, saying if a non-resident is offering something for sale in Canada through an employee, so this is employee, it's not a contractor, okay? And then this is a non-resident person is carrying on business in Canada. But if this company, U.S. company, selling to an independent contractor who resell the item in Canada, is not considered a non-residents carrying on business. And then the next one is disposition of taxable Canadian property by non-residents. See, if a resident of the United States sells a vacation property that he owes in BC, any gain on that sale will be subject to Canadian income tax. So the taxable Canadian property, including real estate, the house, the residential property, and the second, some capital properties and inventories of business carried on in business. And then number 3 is unlisted or unlisted shares, an interest in a partnership or an interest in a trust, or any time within the preceding 60 months, more than 50% of fair market value of the shares or interest was derived from certain property, including Canadian real property, Canadian resources property, and Tamar resources property. So the shares. And those are the gain when you make money from it. The capital gain will be subject to Canadian income taxes. We're going to talk about this more in the chapter 20 for the selling or disposition of taxation Canadian property. Now, so I think that's it for chapter 1. Yeah. So I think that's for the chapter 1. Yeah, let me know if you have other questions.